Well, let's get you updated on our grain trade right now. And last time we checked, we had a rebound taking place in the corn and the soybeans after kind of a sluggish start to the day, let's say. We did have our export sales information that came out earlier today. But right now, things are starting to sag for like the second time today. Right now, you have your December corn, the new crop month, at $5.22, and that is now down 3/4 cents. So we're within about a nickel of our low of the day and about 4 cents from our high of the day. Stuck in the middle, as they say. Well, let's look at soybeans with our quotes provided by bar chart. November now just kind of settling in there at 12.80 and that would be 2 3/4 cents higher. We've been 7 cents higher than this. We have been about 9 cents lower than this. So there you go. Now let's move on to the wheat. In Chicago wheat, here you have December 3 1/4 higher at 717.5 per bushel, and in Kansas City, it is 2 cents higher at 706 per bushel. So we're within about 3 cents of our high of the day right now, and we're off of our earlier low of the day by about 8 cents in the Kansas City wheat. Now keep in mind they're already starting to proceed with some planting in the high plains areas. Spring wheat trade. Minneapolis wheat, December now 3 1/4 lower at 895.5, so a little bit of pressure continuing there. And in the cotton, which they have been leaning on quite a bit earlier this week after the hurricane, boy, they're bouncing back quite a bit today. December up 114 points now at 93.44 cents per pound, so a bit of a rally in the cotton. I did want to point out, before we get into our next guest here, the crude oil market. Take a look at this. October West Texas Intermediate crude up $1.80 at $70.39 per barrel. So it leapfrogged right over that $70 benchmark, back upward again today. Let's bring in Ted Seifried of Zaner Ag Hedge in Chicago and talk about all this. So, you have been mentioning this for several weeks, if not months, that you wondered if maybe we wouldn't have an early harvest low this year. Is that what we have been seeing the start of here? A lot of sluggish pressure here in the grains.
Yeah, I mean, we're certainly working towards that, and we had sort of a spark for that to begin this week with the hurricane and the damage that it did to some of our terminal facilities down in ports. But when you get to this time of year and we don't have a major crop failure, which I'm here to tell you we don't, right? I mean, there are definitely some areas that have struggled this year, but there are other areas that are good. And the net result is that we are going to have corn and soybeans. So we take that weather premium away. Then we start worrying about demand, which, look at export sales this morning. They were good. It was really nice to see a 2 in front of the new crop sales for soybean. But we need to string together 3 or 4 or 5 weeks of this before we can say, hey, that demand is on the books. Now we can start the price ration. And with an absence of that to this point, what we should be doing now is seasonally going lower, offering some good prices for China to come in and everybody else to come in and buy at lower prices, domestic end users to come in at lower prices. This is when cash movement is happening for old crop. Whatever's left is moving right now. And then we will see harvest pressure to some degree. Now, I will say that I think a lot of the bushels that will be coming to town off of harvest have already been priced. So I think, like you said, that harvest pressure comes early this year. We put in that low. Hopefully we get the demand, and then we can say, all right, now we have a tight balance sheet again for next year, especially for soybeans, and now we need to start price rationing. But we can't put the cart before the horse. We can't say, hey, let's price ration here and now, because we don't have that demand on the books. We still need to bring that demand out. We need to draw it out, and I think harvest lows, a little bit lower prices will do that. So longer term, I'm very optimistic about what the balance sheet is going to look like and where soybean prices could be going. It's just this time frame, this seasonality, where I think we do have more pressure and we do offer those opportunities for that demand to build.
All right. Well, Ted, we'll come back and take a look at our cattle and hog market activity here on a Thursday when we come back right after this. Well, we're back with you talking with Ted Seifried of Zaner Ag Hedge. He's located in Chicago. Well, we had the export numbers that came out this morning, and Ted, the grains were kind of flat on the open. Then they rallied, then they sold off, and now they're just kind of, they don't know what to do right now. Let's look at live cattle and see what the livestock trade is doing. And currently on the big board on the live cattle futures, we're trading, well, we'll call it steady to weaker. We have October flat. We have December down 17 cents at 133.42, about a $0.50 off of its earlier high today. Right now on the feeders, October down $1.90 at 166.15. And on the lean hogs, and by the way, we're over $1 lower across the board on feeders. On lean hogs, you have October down 7 cents, and you have December now 42 cents higher at 82.90. So obviously some spread changing there between October and December going on. Ted, what's going on here? Why are the feeder cattle trading so weak today when you have the corn market not necessarily having any runaway success?
Yeah, right. And I feel that's like kind of been a theme here this week, and I don't like it. I feel like there's good reason and rationale for the live cattle market to go higher, but feeders and what's happening there and what's been happening this week make you really pause and question that. And so I don't know. You don't like the looks of the charts in the feeder cattle market right now. You don't like the fact that lower corn prices this week haven't really supported feeder cattle, so you feel like there might be a little bit of trouble there. Back to live cattle again, packers margins are good. You feel like there's more room for cash to go higher, but as feeders are coming down, that could be a limiting factor. So more sideways in this range for live cattle. Is that really what we're going to do now? It seems frustrating, but it is kind of the way it's working. And then when we look at export sales, I'm going to say they were fairly neutral for cattle, pretty good for hogs, but the initial reaction there with hogs lower, I think, is coming from China having a small cancellation on there or reduction in export sales. But overall, I like the look of the lean hog chart. I think there's more upside potential. I still think that October contract, while it is getting beat up on the spreads today, as you said, by the time it goes off the board, I'm thinking somewhere in the upper 90s, like 96 to 98, and possibly in the lower 100s. I think there's more upside potential there.
Well, I'm glad you pointed that out. Ted, I appreciate the time. Thanks for sharing that with us, and great information. Ted Seifried of Zaner Ag Hedge. Tammy, back to you.